Is AI the biggest bubble since the dot-com crash? Everyone's screaming about the AI revolution, and big tech stocks are soaring to unbelievable highs. It feels like 1999 all over again, doesn't it? But what if I told you the smartest move right now might be to bet against the herd? Welcome to the world of contrarian investing, where going against the grain can lead to massive rewards. Today, we're diving deep into why the current AI hype might be a bubble ready to pop, and how you can position yourself to profit when it does. First, let's be clear. AI is a genuinely transformative technology. It's changing industries, creating new possibilities, and it's here to stay. But the technology itself and the stock market's valuation of that technology are two very different things. Remember the internet? It was revolutionary, but in the early 2000s, hundreds of dot-com companies with com in their name but no actual profits went bankrupt. Investors who piled in at the peak lost everything. The hype got way ahead of reality. We're seeing similar patterns today. Any company that mentions AI in an earnings call sees its stock jump. Valuations for some of these companies are astronomical, based on projections of future profits that are years, if not decades, away. The price-to-earnings ratios are stretched to their limits. This is classic bubble behavior, driven by what economists call the greater fool theory. The idea that you can buy an overpriced asset because there's always a greater fool willing to buy it from you for even more. That works until it doesn't. So what does a contrarian investor do? A contrarian doesn't just bet against things for the sake of it. They look for assets that are undervalued because the market is overly pessimistic, and they identify assets that are overvalued because the market is irrationally exuberant. Right now, the AI sector is dripping with irrational exuberance. The first step in our contrarian strategy is to identify the most overhyped areas. Look at the companies with insane valuations that are backed by solid earnings or a clear path to profitability. These are often the darlings of the media, the ones everyone is talking about. While everyone else is buying, a contrarian is patiently waiting, or even looking for ways to short these stocks. Shorting means you're betting the stock price will go down. It's a high-risk strategy, but it can be incredibly profitable if you're right. You could use inverse ETFs that are designed to go up when a specific index, like the Nasdaq, goes down. This is a simpler way for most investors to bet against a sector without directly shorting individual stocks. But being a contrarian isn't just about being negative. It's also about finding the hidden gems that everyone else is ignoring. While all the capital and attention are flooding into a handful of AI megastocks, what's being neglected? Think about boring but essential industries. Sectors like consumer staples, utilities, or certain areas of healthcare. These companies produce things people need, regardless of the economic cycle. They might not have the sexy growth story of an AI startup, but they often have stable earnings, pay dividends, and trade at much more reasonable valuations. Think of it like this. While everyone is at the trendy, overcrowded nightclub, the contrarian is at the quiet, classic bar next door where the drinks are better and half the price. You're looking for value where others see boredom. For example, has the market unfairly punished a solid industrial company just because it's not an AI company? Is there a regional bank with a strong balance sheet that's been overlooked? These are the questions a contrarian asks. Let's talk about a specific historical example, Warren Buffett. During the dot-com bubble, Buffett was heavily criticized. Pundits said he was old-fashioned and didn't get the new tech economy. His company, Berkshire Hathaway, dramatically underperformed the market. But he stuck to his principles of value investing, refusing to buy companies he didn't understand or that were wildly overpriced. And what happened? When the bubble burst, those high-flying tech stocks crashed, while Buffett's portfolio of boring companies like Coca-Cola and CS Candies held up just fine. He didn't just survive the crash, he thrived in its aftermath, using the cash he'd preserved to buy up great companies at bargain prices. That's the power of the contrarian approach. So, how can you apply this today? First, review your own portfolio. Are you overexposed to the handful of tech giants driving the market? It's easy to be, especially if you own index funds. Consider rebalancing. This doesn't mean selling all your tech stocks. It means trimming some of the profits from your biggest winners and reallocating that money to undervalued sectors. You might look into international markets, which have been lagging behind the US, or consider small-cap value stocks, which are historically cheap compared to their large-cap growth counterparts. Another contrarian move is to hold more cash than usual. In a frothy market, Cash is not trash. Cash is your tool for seizing opportunities. When the market panics and everyone is selling, that's when the biggest bargains appear. Having cash on hand allows you to be the buyer when there's blood in the streets, as the old saying goes. It gives you the power to act when others are forced to sell. Let's also consider the psychology of it all. It's hard to go against the crowd. You'll feel FOMO, the fear of missing out, when you see AI stocks continuing to climb. Your friends might be bragging about their gains. The news will be relentlessly positive. To be a successful contrarian, you need a strong stomach and a conviction in your own research. You need to separate the story from the facts. The story is I will change the world. The facts are the balance sheets, the income statements, and the cash flow reports. The story is exciting, but the facts determine long-term value. It's also important to remember that timing the market is nearly impossible. The AI bubble could keep inflating for another month, another year, or even longer. A contrarian strategy isn't about predicting the exact top. It's about recognizing that the risk-reward profile is becoming increasingly unfavorable. You're not trying to be a hero who calls the peak. You're being a prudent investor who reduces risk when valuations become detached from reality. So, let's summarize the contrarian playbook for the AI bubble. Step 1. Identify and reduce your exposure to the most overvalued parts of the market. This might involve trimming big tech winners or even exploring inverse ETFs if you have a high risk tolerance. Step 2. Search for value in the neglected corners of the market. Look for boring, profitable companies and sectors like industrials, healthcare, or consumer staples that the market has forgotten. Step 3. Hold a healthy position in cash. This is your dry powder for when opportunities arise from a market correction. And finally, Step 4. Stay disciplined. Ignore the hype, do your own research, and have the courage to stand apart from the crowd. Betting against the AI hype isn't a prediction that AI will fail. It's a bet that market psychology has gotten ahead of itself. It's a bet on fundamentals over fantasy. It's a challenging path, and it might test your patience. But for those who can think independently and act with conviction, the rewards can be extraordinary. History has shown us time and time again that the biggest fortunes are often made by betting against the madness of crowds. Thanks for watching. If you found this perspective valuable, hit that like button and subscribe for more content that challenges conventional wisdom. Let me know in the comments what you think. Isaya Babor is this time really different. See you next time.